Hey guys, how's it going? Welcome back. In today's video, we're going to look at 15 window dressing methods that businesses use to make their accounts look better. Let's check it out. So what methods do businesses use to make their profit and loss statements appear better? The first method that many businesses use is to rush to sell stock before the end of the financial year, potentially at a large discount. And what this will do is boost the sales revenue. So this was our original profit and loss income statement on the left hand side, and what we've got now is our new profit and loss statement after rushing to sell stock. Now you'll notice that obviously the sales revenue has significantly increased. That has also increased the gross profit. Its gross profit increased, that also increases the operating profit and thus the net profit. So what effect has that had? Well, firstly, it makes the business appear more successful from a sales perspective. It also improves the gross profit and the net profit, along with the gross profit and net profit margins, as long, of course, as all of the other figures remain the same. Note, the cost of sales figure is also likely to increase, of course, if you've managed to make more sales. However, you may have been able to increase the sales revenue by giving significant discounts, but of course that will increase your discount allowed in your expenses. The second method that businesses use to make their profit and loss statements appear better is to delay paying for raw materials. Businesses may buy goods on trade credit. They'll take delivery now, they'll sell on to the customers, and they'll declare the cost in next year's cost of sales or next period's cost of sales. So once again, on the left-hand side, we have our original profit and loss statement, our income statement, and on the right-hand side is where our new statement will be. You can see that delaying payment for raw materials means that our sales revenue will increase significantly. Our gross profit also would increase, as well as our operating profit and net profit. But of course, what are the impacts of this? Well, it would significantly increase your sales revenue, gross profit and net profit, as long as all other figures remain the same. It will also, of course, enhance our gross profit margin and net profit margin ratios, but the fact that you've taken goods on trade credit will mean that it will negatively impact next year's or next period's cost of sales figure, because you will not be declaring the significant cost of your raw materials until next period's cost of sales. The third method that businesses may use to window dress their accounts is to delay payment for expenses until the end of the financial year. So on the left we have our original profit and loss statement, and then on the right we have our new one. You can see that we're delaying paying for our expenses until the following period. So we're delaying wages in this case, we're delaying our rent payments. That will overall reduce our total expenses, thereby increasing our operating profit and our net profit. But what impact does that have? Well, as we said, it reduces our total expenses figure and therefore increases our operating profit margin and our net profit margin, as long as, of course, as all other figures remain the same. However, in this case, we've delayed payment of wages. Staff, of course, may not be willing to wait for wage payments. They may become demotivated and have fears over job security if they perceive the business to have liquidity issues. It may also be the case, especially of course with rent, that landlords may be unwilling to wait for rental payments. This may cause them to think you have cash flow difficulties, and they may increase rent if they believe you are a higher risk tenant. The fourth window dressing method is to declare allowable expenses. So on the left is our original, on the right is our new statement. You can see here that on the left we haven't declared any of these so-called allowable expenses. However, on the right hand side As part of our expenses, we have declared allowable expenses of £1,200. This has actually increased our expenses from 10,600 on the left-hand side to 11,800 on the right-hand side, thereby actually bringing down our operating profit and bringing down our net profit. Now, why might businesses wish to do this? Well, this would generally apply more so for smaller organisations. There are allowable expenses that businesses are able to claim, and I'll do a separate video on this and leave the link in the description. This increases their total expenses and of course reduces their operating profit and net profit, which means of course that they'd have a smaller corporation tax liability, so they would not have to pay as much out in tax. However, of course, although you benefit from not paying as much tax, it would also mean that the return on capital employed ratio measure would appear worse. So potentially if you're looking for investment and want to persuade investors that you're a high returning company, it would not be wise to increase your expenses by declaring allowable expenses. The fifth method of window dressing many businesses may consider using is to sell one-off exceptional items before the end of the financial year. So the left-hand side is the original, and of course the right-hand side is the new profit and loss account. You can see we've chosen to sell off an exceptional item. This is an item that belongs to us, it's an asset to us, but of course we've chosen to sell it off in order to generate one-off exceptional profit. Of course, we can't repeat this year in, year out, because once the asset has been sold, usually, unless you use sale and leaseback, you are unable to continue using the asset. You can see, of course, it's increased the net profit significantly, although all the other figures have remained the same. So just from selling an exceptional item, what has the impact been? Well, significantly increase the exceptional items figure and therefore increases the net profit. It will, of course, for that specific year, improve the return on capital employed measure, and it makes businesses appear more attractive to potential shareholders or to investors. Having made more profit, albeit through the sale of an exceptional item, the return on capital employed measure would look better. However, businesses may not be able to use that exceptional item again, as mentioned, unless they leased it back, which may cause issues in the future. And it also increases your tax liability. Of course, the more net profit that an organisation makes, the more corporation tax they'll have to pay. This, of course, is a negative if you want to reduce your tax liability. So next we're going to have a look at some of the methods, some of the window dressing methods that organisations use in order to make their balance sheet appear better. So as you can see in front of you, you have a generic balance sheet with different types of assets, both fixed and current, and then the current liabilities. Based upon current assets and liabilities, of course, we can work out our working capital. I've done a video on working capital and I'll leave a link in the description. And then we have our bottom of our balance sheet, our retained profit, our share capital, and our shareholders' funds. So the first method that businesses may use to window dress their balance sheet, and the sixth method overall, is to depreciate tangible fixed assets. So on the left you can see your original balance sheet, and on the right the new one. So by depreciating tangible fixed assets, we can see that our fixed asset figure has gone down substantially, in this case £10,000 to £50,000. This would reduce our total assets figure, our share capital figure, and thus our shareholder funds figure. But what effect will depreciating tangible fixed assets have? Well, of course, it will reduce all those figures, the total assets, the share capital, and the shareholders funds figures, and it's usually beneficial to the return on capital employed ratio, because you are generating the same return based upon a reduced capital employed figure. The seventh method overall that businesses may choose to window dress their accounts is to appreciate tangible fixed assets. So this is the opposite of the previous option. This option, we are increasing the value of tangible fixed assets. So on the left, the original, and on the right is the new balance sheet. Our fixed assets have increased by 10,000. Our total assets have therefore also increased, as well as our share capital and our shareholders' funds. What will the impact be? Well, it will of course be detrimental to the return on capital employed ratio, because you'll be generating the same return shown in the profit and loss account, but with an increased capital employed figure. However, why would we do this? Well, it may be done before a valuation. If the firm is hopeful of being taken over, or if the entrepreneur, the owner, is hopeful of a sale of his or her firm, they may wish to appreciate the tangible fixed assets because it will show the business as more valuable overall. The eighth method that businesses may use to window dress accounts is to depreciate intangible fixed assets. Intangible fixed assets, of course, being those ones which are not physical, that you cannot touch or hold. Might be things, for example, like a brand name. So why would you want to depreciate or reduce the value of a brand name? Well, in this case, you can see that on the left is the original, on the right you have once again reduced the value of your fixed assets. What would the impact of that be? Well, once again, it would reduce the total assets, share capital and shareholders' funds figure, once again being beneficial to the return on capital employed ratio. Many investors may consider the return on capital employed ratio as extremely important before they make a decision as to whether to invest or not. So by depreciating your fixed assets, you will actually increase the outcome of that ratio. The ninth point, how businesses window dress, is to appreciate intangible fixed assets. So once again, our fixed assets have increased. This would have the effect of increasing our total assets, share capital and shareholders' funds. Whilst it may be detrimental to the return on capital employed ratio, it might of course be done before a valuation. The 10th method that businesses may consider to window dress their accounts is to keep fixed assets on the balance sheet until the end of the financial year, agreeing a sale date a short time afterwards. On the left is the original, and on the right is the new balance sheet. You can see here, as we are keeping fixed assets on the balance sheet for longer, our fixed assets have increased. This would also increase our total assets, our share capital, and of course our shareholders' funds. Why would we do this? Well, apart from increasing those figures, it may be detrimental to the return on capital employed ratio, but once again, if we are trying to sell our organisation, or we believe we may be the target of a takeover, it would be wise in our accounts to increase the value of our assets as we appear a more valuable organisation overall, and therefore it might increase the amount that a takeover may generate for the owners of the organisation. The 11th method is to sell off fixed assets to boost the cash held figure. On the left is the original, on the right is the new balance sheet. So in this case, we're going to sell off fixed assets, and the benefit of that, in this case, we've sold 10,000, would be that our cash would also increase by 10,000. This would significantly impact on our working capital. In this case, as we can see, originally our total current assets were 13,000 plus 3,500 plus 4,500, totaling 21,000 in total. And that would mean that on the new balance sheet, our new current assets figure would be 13,000 plus 13,500 plus 4,500, giving us a significantly increased current asset figure of £31,000. So why would we want to do this then? Well, selling off fixed assets to boost the cash held figure reduces the fixed asset figure as well as increasing cash holdings. It really makes sense if fixed assets are not being used at the end of the day. If they're not being used, we may as well sell them off in order to boost our cash reserves. It's a really good idea in the short term if the fixed assets can be sold and leased back. This will enable an organization to continue using any fixed assets that they require the use of. And perhaps more importantly, it improves the liquidity ratios. The current ratio and the acid test ratio will be significantly improved by boosting our cash reserves. The 12th method of window dressing that businesses may consider using is sale and leaseback of fixed assets. Here is the new and improved, some may say, balance sheet on the right hand side. And what has happened? Well, we've reduced our fixed assets figure, we've sold them off, and now we're leasing them back. Of course, that would increase our cash holdings and significantly benefit our working capital. So why would we want to do it? Well, apart from reducing the fixed asset figure and increasing our cash holdings, it once again makes sense if fixed assets are not being used. It's a good idea in the short term, especially if we can lease back, and it improves our liquidity measure. Is it always possible to lease back assets that we've sold? The answer is, of course, no. It's important that we establish whether it's going to be possible to lease these assets back before we commit to a sale. The 13th method of window dressing businesses may consider using is to overvalue their stock. On the right hand side is the new balance sheet. What has happened is we've valued on the left hand side our stock holdings at 4,500. On the right hand side, that figure has increased to 9,000. This may be because there's suddenly been a change of trend in the market, and therefore any stock we're holding would be, of course, of a greater value. You can see the change it has. We've increased our working capital. We've also increased our total assets, our share capital, and thus our shareholders' funds. So the effect it would have, well, as we said, it would increase the working capital figure significantly, showing benefits to the liquidity of an organization. It would improve the current ratio, but it would not actually increase the acid test ratio, because in the acid test ratio, of course, we take away the stock. It would increase total assets, share capital, and shareholders' funds, and of course, therefore, this suggests that it may be a wise thing to do before we have a valuation. The 14th method, on the flip side, is actually to undervalue stock. On the right hand side, you can see this in action. The stock used to be worth 4,500, but we have valued it now at 2,500. This actually reduces our working capital, our total assets, our share capital, and of course our shareholders' funds. So why on earth would we want to do this? Well, it would reduce the working capital figure, and it actually reduces the current ratio, as we said. But it may make the acid test ratio appear better if the business is holding less stock. However, potentially the most important factor is that it improves our return on capital employed ratio. Now, how much it will improve the return on capital employed ratio depends on how much stock an organization generally holds. And the 15th method of window dressing is to keep bad debtors even though there is little to no chance of receiving payment. So you can see here on the left is the original, on the right is the new balance sheet. Many businesses may write off bad debt. However, by keeping on bad debt in our balance sheet, our debtors figure is artificially increased, our working capital is also increased, our total assets also increased, our share capital, and of course our shareholders' funds. So why would you want to keep bad debt on your balance sheet even though there's little to no chance of receiving payment? Well, it increases the working capital figure significantly in this case. You can see it's gone up from 12,000 to 17,000. It improves also the current ratio. It increases the total assets, share capital, and shareholders' funds. Well, of course, if we're after a good valuation, that can be hugely beneficial. And it also ensures the business appears to be more liquid than it may otherwise be. The liquidity ratios are some ratios used by investors. So if an investor is looking for a company which is highly liquid, then keeping bad debtors on your balance sheet may be beneficial. Thanks for watching the video. Make sure you subscribe for more money and finance related videos.